Could Micron, MU, reach $1,500? A deep analysis. Introduction. Micron Technology, $MU, is the only leading-edge memory semiconductor manufacturer headquartered in the United States, competing primarily against South Korea's Samsung and SK Hynix. As of May 2026, the company has transitioned from a cyclical chipmaker to a structural cornerstone of global AI infrastructure. With shares recently surging toward record highs, a fierce debate has emerged. Is the current price a peak, or is it merely the prelude to a $1,500 valuation? While the Wall Street consensus remains anchored by historical models, some aggressive analysts have recently outlined a path to $1,500, arguing that AI-driven, compounding demand could produce a structural re-rating of memory stocks, with some drawing comparisons to the scale of opportunity seen in the early Internet era, 11.1, 11.2. This analysis goes beyond the surface debate. Rather than simply presenting bull and bear talking points, it examines each commonly cited risk: cyclicality, customer concentration, geopolitical exposure, Chinese competition, execution risk, and AI demand uncertainty, against current evidence from primary sources including Micron's own SEC filings, U.S. Navy intelligence testimony, Fitch Ratings credit analysis, Bloomberg economics modeling, and leading semiconductor industry research. Where the evidence finds risks to be overstated, transitional, or inverted into competitive advantages, it says so directly. Where genuine risks remain, it identifies them precisely rather than broadly. The geopolitical section in particular goes deeper than most financial analysis, examining how the timing of China's naval build-out, the ongoing Iran conflict's impact on Korean fab economics, and Micron's own Taiwan production dependency interact, and why the timing of Micron's U.S. fab build-out resolves that tension in a way that is analytically significant. The path to $1,500 is not guaranteed, but as this analysis will show, it is analytically grounded. One, the geopolitical dimension. The opportunity. Because Micron is US-based, it has become strategically significant to the US government and its allies as AI increasingly intersects with national security. Micron's New York fabrication facility officially broke ground on January 16, 2026, in a ceremony attended by Commerce Secretary Howard Lutnick and Senator Chuck Schumer, a rare bipartisan signal of the facility's national security status, supported by CHIPS Act funding, which positions it as a domestic supplier for defense and critical infrastructure applications. 1.1. 1.3. Some analysts argue this creates a degree of demand protection that its Korean competitors cannot easily replicate in U.S. government contracts. Beyond the domestic policy advantage, a growing geopolitical stability gap has opened between Micron and its two primary competitors. While Micron is scaling capacity in the stable interior of the United States, Samsung and SK Hynix are simultaneously navigating what analysts have described as a triple geopolitical threat. 3.2. 1.1 The energy and helium crisis. Iran conflict. The ongoing conflict in the Middle East has effectively blocked the Strait of Hormuz, through which South Korea routes roughly 70% of its crude oil imports. 1.2. This has triggered a compounding shock to the Korean economy: record inflation, a 17-year low for the won, and surging industrial electricity costs, all of which directly affect fab operating economics. 3.2. Industry analysis from Omdia confirms that electricity costs have been skyrocketing for energy-intensive fabs in Taiwan and South Korea as a result of the crisis, with the broader energy shock forcing difficult choices between residential and industrial power allocation. 14.1. More critically, South Korea sources roughly 65% of its ultrapure helium, essential for heat management in leading-edge semiconductor fabrication, from Qatar. 9.1. Following Iranian drone strikes on Qatar's Ras Laffan LNG complex in March 2026, helium prices spiked and Korean fabs have been operating under helium rationing protocols, creating yield risk that Micron, with its North American supply lines, does not face. 2.1, 14.1. (1.2) The Taiwan Strait Risk Premium and the 2027 Naval Threshold. As China continues to project military power into the South China Sea and the Taiwan Strait, the regional semiconductor cluster spanning Taiwan, South Korea, and Japan is facing a rising insurance and logistics premium. What makes this particularly relevant to Micron's competitive position is a specific set of military milestones expected in the 2027 to 2028 window that analysts argue could materially alter the risk calculus for fabs located within the first island chain. Type 096 submarine. Tank-class Chinese state media published new technical data in January 2026 on the Type 096 tank-class ballistic missile submarine, widely viewed as the backbone of China's future sea-based nuclear deterrent. 13.1. U.S. Navy intelligence, in testimony from Rear Admiral Mike Brooks in March 2026, confirmed that the Type 096 and Type 095 are expected to enter service in the late 2020s through the 2030s, and that China's submarine fleet could reach roughly 70 boats by 2027, 13.2. Separately, a January 2026 CCTV broadcast appeared to show a Type 096 hull participating in a war game, leading analysts to speculate it may have already entered limited service, 13.3. The strategic implication: a quieter, longer-range SSBN operating from South China Sea bastions increases China's ability to enforce gray zone pressure on regional shipping lanes without requiring open conflict. Type 004 nuclear carrier. Satellite imagery analyzed by the War Zone and confirmed by Janes shows the Type 004, China's first nuclear-powered aircraft carrier, under active construction at the Dalian shipyard, with hull sections, reactor containment structures, and catapult infrastructure visible as of late 2025, 13.4, 13.5. Defense analysts estimate a launch window of 2028 to 2029 based on the pace of visible construction, 13.6. Unlike conventionally powered carriers, a nuclear-powered carrier strike group provides sustained blue water power projection without refueling constraints, significantly expanding the operational envelope of planned forces beyond China's near seas. The Pentagon's 2025 China Military Power Report noted that China's next generation of carriers will feature greater endurance, increasing the striking power of potential carrier battle groups deployed to areas beyond the PRC's immediate periphery, 13.5. The supply chain implication. In a severe scenario involving a blockade or sustained gray zone operation in the Taiwan Strait, Micron's Idaho and New York facilities would represent the only leading-edge memory fabs on the planet operating entirely outside the immediate zone of risk. Bloomberg Economics modeling has estimated that a Taiwan Strait conflict could produce a $10 trillion hit to global GDP, with South Korea, due to its geographic proximity and energy import dependency, among the most exposed economies. 13.7. Micron's domestic expansion, in this framing, is not just a capacity investment, it is a structural hedge that becomes more valuable as regional military risk rises. This does not mean conflict is likely or imminent. Most analysts consider a near-term kinetic scenario low probability. But supply chain planners and institutional investors increasingly price in tail risks, and the directional trend of planned capability development is unambiguous. The 2027 to 2028 window, when both the expanded submarine fleet and the Type 004 program reach key milestones, represents a meaningful inflection point in how that tail risk is priced. (1.3) SK Hynix's China manufacturing exposure. Unlike Micron, which is actively onshoring its future capacity, SK Hynix still maintains a significant manufacturing footprint in China. This leaves it uniquely exposed to crossfire risks, where U.S. equipment export restrictions or Chinese retaliatory measures could constrain its ability to upgrade those facilities. 9.1. Fitch Ratings, in upgrading Micron to BBB+ in May 2026, specifically cited Micron's comparatively lower geopolitical risk relative to SK hynix as a factor in its improved credit outlook. 4.4. Verdict: the stability premium for Micron is no longer theoretical. In 2026, Micron is not merely selling memory, it is offering guaranteed delivery from politically stable, domestically secured fabs at a moment when its competitors face energy supply disruption, currency pressure, and manufacturing footprint risk that Micron simply does not. The risk, and why the timing resolves it. The geopolitical stability argument has an important near-term qualification. Taiwan currently accounts for more than 60% of Micron's total global DRAM production capacity, and HBM4E-based logic dies will be manufactured by TSMC in Taiwan. 16.1, 14.4. A Taiwan Strait disruption in 2026 or 2027 would therefore affect Micron's own output, not just its competitors. However, the critical insight is one of timing. The planned naval milestones that create the most serious gray zone risk, Type 096 fleet expansion and the Type 004 carrier, reach meaningful operational maturity in the 2028 to 2030 window. 13.2, 13.6. By that same window, Micron's Idaho Fab 1 will be in volume production from mid-2027, Idaho Fab 2 will be ramping, and US-based HBM assembly capabilities are planned to follow. 16.2, 16.3. The Taiwan dependency is a present reality that is being actively resolved through the US Fab build-out, and the resolution timeline aligns almost precisely with the window in which the naval threat becomes most consequential. The safe haven thesis is therefore not premature, it is correctly timed. 2. Technology, the 1-gamma node. The opportunity. Micron has reported that its 1-gamma DRAM node delivers meaningful power efficiency improvements over previous generations, approximately 20% lower power consumption compared to prior nodes. 4.2, 4.3. In an environment where data center power consumption is a genuine infrastructure constraint, with AI data centers projected to require an additional 92 gigawatts of power by 2027, 12.1, energy-efficient memory has real commercial value that goes beyond performance alone. The risk: technology leads in semiconductors are typically temporary. Samsung and SK hynix are also investing heavily in next-generation DRAM nodes and high-bandwidth memory, HBM. Claims about Samsung's yield difficulties in logic chips, its 2nm GAA process, are sometimes cited as evidence of Micron's competitive strength, but these are different product categories. Logic chip manufacturing challenges do not directly translate into memory manufacturing weakness. Readers should be cautious about conflating the two. 3. AI and industrial demand. The opportunity, the growth of AI infrastructure, both in hyperscaler data centers and in industrial automation settings, is driving genuine demand for high-bandwidth memory, HBM4, and high-performance storage. This is part of a broader shift that is expected to push the global semiconductor market past the $1 trillion revenue threshold in 2026, with DRAM revenues alone projected to nearly triple. 12.2. Micron is one of 3 suppliers of HBM globally, and as of January 2026 has moved into full-scale high-volume production of HBM4, with shipments currently going to NVIDIA for the Vera Rubin platform. 2.1, 2.2. Because HBM4 requires significantly more wafer area per unit than standard DRAM, total supply is physically constrained in ways that may moderate the oversupply cycles that historically depressed memory prices. 5.1. The risk: AI infrastructure spending is currently concentrated among a small number of large customers, Microsoft, Google, Amazon, Meta, and demand forecasts from these customers have historically been volatile. Additionally, If AI workload growth plateaus or model efficiency improves faster than expected, demand projections could prove too optimistic. These risks are examined in greater depth in Section 5, where the analysis finds that both concerns are likely transitional rather than structural given the broadening of AI adoption across industries and the self-compounding nature of AI-generated data. (4) Valuation. The $1,500 debate, what the math actually requires. The path to $1,500 rests on two variables, earnings power and the multiple the market assigns to those earnings. On earnings, the current Wall Street consensus is more supportive than many expect. Analysts on average forecast Micron's EPS to reach approximately $101 for calendar year 2027, with the range spanning $54 on the low end to $150 on the high end, 15.1. The DEX $100 EPS reach case is therefore not a fringe projection, it is close to the current analyst consensus for peak earnings. On the multiple, Micron's historical cyclical P/E has averaged around 6x. A re-rating to 15x, the sovereign AI utility argument, applied to $100 EPS produces exactly $1,500. Where the bear case lies, the conventional objection is not that $100 EPS is unreachable, it is that it won't last. The same analyst consensus that forecasts $101 EPS for 2027 projects a sharp decline to approximately $18 EPS by 2028, reflecting the traditional view that peak memory earnings are followed by cyclical contraction as new capacity arrives. At 15x the 2028 consensus of $18, the implied price is approximately $270, not $1,500. The bear case therefore does not dispute the near-term earnings, it disputes their durability. Why our analysis challenges the bear case? This is precisely where the risk analysis in Section 5 becomes directly relevant to the valuation debate. Our analysis found that the traditional drivers of cyclical earnings contraction have been structurally weakened in Micron's specific case. HBM's physical 3:1 wafer constraint cap supply regardless of investment levels, 5.1. The first wafer output from Idaho and New York fabs is not expected until mid to late 2027 at the earliest, 2.2, 14.2, meaning no meaningful new supply arrives before the earnings peak. Korean competitors face compounding energy, helium, and currency headwinds that constrain their ability to expand output, 14.1. Chinese competition remains a generation behind in HBM, 9.3. And AI demand is broadening and self-compounding in ways that sustain the revenue base, 14.1. Each of these factors individually weakens the bear case. Together, they mount a credible argument that the 2028 earnings decline the consensus assumes may not materialize as projected, or may be shallower and shorter than prior cycles. The multiple re-rating question, the move from 6x to 15x is the second required condition. This is the more speculative of the two. It requires the market to accept that Micron is no longer a commodity memory manufacturer but a structural AI infrastructure utility, a reclassification that Fitch's BBB plus upgrade, 4.4, and the national security mandate behind the New York fab, 1.1, 1.3, both begin to support institutionally. Whether that re-rating fully materializes at 15x, partially materializes at 10x, or fails to materialize at all is ultimately a market psychology question as much as a fundamental one. At 10x the 2027 consensus EPS, the implied price is approximately $1,000, the D.A. Davidson target, 5.2. At 15x, it is $1,500. The difference is entirely in the multiple. The bull case, as of May 2026, Micron's forward P/E remains well below AI-adjacent peers, which proponents argue reflects an outdated cyclical discount. The structural changes documented in this article, HBM supply constraints, geopolitical stability premium, Korean competitor headwinds, and compounding AI demand, collectively support the argument that the discount is no longer analytically justified. The bear case: even with structural changes, the memory industry has historically found ways to surprise to the downside. A 15x PE is still a significant re-rating for a capital-intensive hardware manufacturer. The 2028 consensus EPS decline, if it materializes even partially, would make a $1,500 valuation difficult to sustain. Earnings durability, not earnings level, is the central question. On insider activity, CEO Sanjay Mehrotra sold 40,000 shares in May 2026 under a pre-planned 10b5-1 trading plan established in January. 5.1. Pre-planned sales are a routine and legally required mechanism for executives to monetize holdings and do not, by themselves, indicate a negative outlook. His continued ownership of over 1 million shares is also a matter of public record. Neither fact alone is a reliable signal of future stock direction. Five Key risks and demand factors, analysis. Risk 1, cyclicality, traditional cycle mechanism fundamentally disrupted. The traditional memory cycle, oversupply leading to price crashes, was driven by undifferentiated commodity production where all three major suppliers expanded capacity simultaneously, flooding the market. Several structural changes make a repeat of that pattern less likely in the near to medium term. First, HBM is physically supply-constrained in a way standard DRAM never was. Because HBM4 requires roughly 3 times the wafer area of conventional memory, total output is capped regardless of how aggressively suppliers invest. 5.1. This is a hard physical limit, not a market judgment call. Second, Micron has exited consumer memory entirely, eliminating its most cyclically volatile revenue stream and concentrating on higher margin, longer duration enterprise contracts. 7.1. Third, Micron's own CEO has stated publicly that aggregate industry supply is expected to remain substantially short of demand beyond 2026. 7.2, a position supported by independent supply chain analysis indicating that new memory fabrication capacity is not expected to come online until late 2026 at the earliest. 7.3. It is worth noting that Micron's 10Q filing still carries boilerplate disclosure language acknowledging historical DRAM price swings of plus or minus 40% in a single fiscal year. 8.1. However, this disclosure reflects the company's legacy commodity DRAM profile rather than its current revenue mix. As HBM, which carries significantly higher and more stable margins than standard DRAM, becomes an increasingly dominant share of Micron's revenue, the relevance of this historical volatility language diminishes. It is standard SEC disclosure practice to retain such language even as the underlying business transforms, and readers should interpret it in that context rather than as a signal that commodity-style earnings swings remain the primary risk. The one concrete watchpoint is late 2027 to early 2028, when first wafer output from Micron's Idaho and New York fabs is currently expected. 2.2, 7.3. If AI demand growth decelerates at the same time that supply increases, the conditions for a price correction would re-emerge. However, this timeline actually strengthens the near-term bull case. The supply shortage is now expected to last longer than even the most optimistic analysts projected in 2025, meaning pricing power and margins are likely to remain elevated for an extended period. 10.2. This is a dated, specific risk to monitor, not a general cyclicality concern that applies equally today. Verdict: the traditional cyclicality risk has been meaningfully restructured by HBM's physical constraints and the shift to enterprise contracts. It is not the same risk it was in prior decades. The late 2027/early 2028 supply ramp is worth watching, but it requires demand to simultaneously disappoint, which current evidence does not support, and which the extended shortage timeline makes increasingly unlikely in the near term. Risk 2, customer concentration, present today, but likely diminishing. A significant portion of HBM demand currently flows from a small number of hyperscalers, primarily Microsoft, Google, Amazon, and Meta. 2.2. In principle, a spending pullback or inventory correction at even one or two of these customers could disproportionately affect Micron's revenue, and in prior cycles, cloud CapEx pauses have contributed to sharp memory price corrections. However, there is a credible counterargument that this risk is self-correcting over time. AI adoption is not staying confined to hyperscalers. Enterprises across financial services, healthcare, manufacturing, and defense are building or expanding their own AI infrastructure to remain competitive, creating a second wave of demand from a much broader and more diversified customer base. 2.2. Micron's own pivot toward industrial AI, edge devices, and sovereign AI cloud contracts, discussed in Section 1, reflects exactly this broadening. 3.2. A world in which only 4 companies drive AI memory demand is a 2024 picture. The 2026 trajectory points toward diffusion across industries and geographies. If that broadening continues, the concentration risk diminishes structurally rather than requiring active management. The residual concern is timing. The diversification of AI demand is still underway, meaning near-term revenue remains more dependent on hyperscaler spending than it will be in 2 to 3 years. Verdict: a real but likely transitional risk. Worth monitoring in the near term, but the structural direction, broader AI adoption across industries, works against it over time. The more telling signal is Micron's own behavior. Rather than lobbying to protect or restore Chinese market access, Micron is actively pushing Congress to pass the Match Act, legislation specifically designed to tighten equipment export restrictions on CXMT and YMTC. 9.1. A company that genuinely viewed Chinese market exposure as a critical revenue risk would not be lobbying to deepen the restrictions that limit its ability to sell there. The lobbying position reveals Micron's internal calculus: slowing Chinese competitors' technological development is worth considerably more than preserving Chinese customer access. This effectively inverts the risk. Geopolitical tension, in Micron's specific case, functions more as a competitive moat than a revenue threat, particularly if the Match Act or equivalent legislation passes and further constrains CXMT's ability to acquire advanced chip-making equipment. 9.1. Verdict: the conventional geopolitical risk framing is overstated. China revenue exposure is limited and Micron's Match Act lobbying reveals it views restrictions as a net competitive benefit. The more important near-term qualification is Micron's own Taiwan production dependency. Over 60% of current output and HBM4E-based dies are Taiwan-based. 16.1, 14.4. However, the critical timing dynamic resolves this tension. The planned naval milestones that create genuine Taiwan Strait risk mature in 2028 to 2030, 13.2, 13.6, precisely when Idaho Fab 1 enters volume production, Idaho Fab 2 ramps, and US HBM assembly comes online, 16.2, 16.3. The Taiwan dependency is a present-tense reality being resolved on a timeline that aligns with, rather than conflicts with, the emerging threat window. This makes Micron's U.S. build-out not just a capacity investment but a strategically well-timed transition out of geopolitical exposure. Risk 4, Chinese competition, overstated in the near term, worth monitoring long term. The original framing of this risk, that CXMT is closing the gap rapidly, requires important qualification when the actual technology positions are compared directly. Micron entered 2026 with its entire HBM4 production capacity for the year already sold out through advance contracts, 10.1, 14.2. For 2027, Micron's own earnings calls confirmed that HBM4E volume ramp is on track and that the company expects to ramp volume in calendar 2027, with customized HBM4E variants, developed in partnership with TSMC, expected to deliver higher gross margins than standard products. 14.3, 14.4. The HBM TAM itself is forecast by Micron to grow at approximately 40% CAGR through 2028, from roughly $35 billion in 2025 to around $100 billion in 2028, 14.2. CXMT, by contrast, is targeting HBM3 mass production by late 2026, 9.3, a generation that Micron, SK Hynix, and Samsung have already commercialized and moved beyond. This is not a company on the verge of disrupting the high end of the market, it is a company attempting to enter a tier that the leading players are actively vacating in favor of the next one. The technology gap matters for a specific reason. HBM4 and beyond are where the highest margins, the most strategically important customer relationships, and the strongest pricing power reside. CXMT entering HBM3 production in volume adds supply at the low end of the HBM spectrum, relevant for cost-sensitive applications, but not a direct threat to Micron's position in AI accelerators, hyperscaler GPU memory, and next-generation inference infrastructure. On NAND, YMTC's rise to potential third-place producer is a more immediate competitive dynamic, 9.4, but Micron has itself been de-emphasizing commodity NAND in favor of enterprise SSDs and higher-margin storage products, reducing its exposure to the segment where Chinese competition is most acute. The longer-term question, whether CXMT can compress multiple generations of HBM development within 3 to 5 years, is worth monitoring, particularly given state-backed funding levels. But compressing a decade of R&D is not the same as achieving it, and export restrictions on advanced chip-making equipment are specifically designed to slow that compression. 9.1. Verdict: overstated as a near to medium-term risk. The generational gap in HBM technology is wide and actively widening as Micron moves to HBM4E and beyond. Chinese competition is a legitimate long-horizon concern, but not a threat to Micron's core AI memory business in the current product cycle. Risk 5, execution risk on the New York mega fab, overstated in context. The framing of this as a significant risk misses two important contextual points. First, the New York facility is one component of a geographically diversified $20+ billion annual capital expenditure program that includes simultaneous expansion in Idaho, Taiwan, and Japan. 10.1. No single facility represents a concentrated revenue or execution dependency. A delay or cost overrun in New York would be absorbed across a broader manufacturing footprint, unlike a scenario where one fab represented the entirety of Micron's capacity growth. Second, and more importantly, the timing works in Micron's favor rather than against it. Meaningful output from the New York facility is not expected until 2027 or later, 7.3, by which point the compounding AI demand dynamics discussed in Note 6 will have had additional years to deepen. More enterprises will have deployed AI infrastructure, more data will require storage and processing, and the addressable market for advanced memory will be larger than it is today. New capacity arriving into a structurally larger demand environment is an opportunity, not a risk. The CHIPS Act compliance requirements are real administrative obligations, but they are known constraints that Micron entered into deliberately as conditions of the subsidy, not unexpected risks that could materially alter the investment thesis. 8.1. Verdict: overstated as a risk. The New York fab is a proportionally small piece of a diversified global expansion, and its output timeline aligns with, rather than runs against, the expected trajectory of AI memory demand. Long-horizon execution uncertainty exists for any multi-decade infrastructure project, but it does not represent a meaningful near or medium-term concern for Micron's business. Note 6, AI demand, a structural tailwind, not a meaningful risk. The original framing of this risk, centered on whether large companies might reduce AI infrastructure spending, misses two important dynamics that work strongly in the opposite direction. First, AI demand is global and increasingly democratized. It is not confined to a handful of US hyperscalers. Enterprises, governments, research institutions, and startups across every industry and geography are deploying AI workloads, building private infrastructure, and integrating AI into existing products. 2.2. Every new deployment, whether a hospital running diagnostic models, a manufacturer deploying agentic automation, or a government building a sovereign AI cloud, adds to cumulative memory and storage demand. This is a broad-based structural shift, not a single customer dependency. 3.2. Second, and perhaps more importantly, AI is self-reinforcing in its demand on hardware. The output of AI systems, generated text, images, video, code, decisions, and data, itself becomes new data that must be stored, processed, and used to train or fine-tune further models. As one industry analyst has framed it, hardware is now chasing data that AI itself creates, a synthetic data loop that requires exponentially greater HBM bandwidth with every successive model generation. 14.1. This creates a compounding dynamic. More AI usage produces more synthetic data, which requires more storage and faster processing, which drives demand for higher bandwidth memory. Unlike traditional software, where usage and infrastructure scale roughly linearly, AI workloads create expanding data volumes that accelerate hardware requirements over time. Micron's CEO has explicitly stated that AI is driving increased memory requirements across the entire product stack, from data centers to edge devices like smartphones and PCs. 7.2. The efficiency counterargument, that better models will require less memory per inference, is real but likely to be offset by the Jevons paradox. As AI becomes cheaper and more efficient to run, usage expands faster than efficiency gains reduce consumption, resulting in higher total demand rather than lower. Verdict: this risk is currently overstated. The weight of evidence, global adoption breadth, output-driven data compounding, and historical patterns of efficiency-driven demand expansion, suggests AI memory demand is more likely to surprise to the upside than the downside over the medium term. 6. Conclusion. This overview set out to present a balanced picture of Micron's position as of May 2026. What the analysis ultimately reveals is that several risks commonly cited in financial commentary, when examined against current evidence, are either structurally weakened, transitional, or in some cases inverted into competitive advantages. The table below summarizes where each factor landed after analysis. Factor. Initial framing. Conclusion after analysis. Cyclicality. Real, recurring risk. Traditional cycle mechanism fundamentally disrupted. HBM's physical 3:1 wafer constraint cap supply regardless of investment levels, while AI demand compounds from multiple independent vectors simultaneously, hyperscalers, enterprise, sovereign clouds, edge devices, and the synthetic data loop. The simultaneous presence of a hard supply ceiling and accelerating demand diffusion removes the conditions that historically produced price crashes. One monitoring point remains: the late 2027/early 2028 supply ramp, which requires demand to simultaneously disappoint to become a risk, an increasingly unlikely scenario given the demand trajectory documented in this analysis. Customer concentration. Significant risk. Transitional. Hyperscaler dependency is real today but actively diminishing as AI adoption broadens across industries and geographies. Geopolitical exposure. Active bilateral risk. Inverted into a structural moat, with a critical timing insight. Korean competitors face the triple threat. Taiwan currently hosts 60% plus of Micron's production, but the planned naval threat matures in 2028 to 2030, precisely when Idaho Fab 1 enters volume production and US HBM assembly comes online. The Taiwan dependency is being resolved on a timeline that aligns with the emerging threat window, making the U.S. build out a strategically well-timed transition, not a delayed response. Chinese competition. Closing gap rapidly. Overstated near-term. CXMT targets HBM3 by late 2026 while Micron is in HBM4 mass production and transitioning to HBM4E. The generational gap is wide and widening. Long horizon monitoring remains warranted. New York fab execution risk. Real, long-dated. Overstated. The fab is one of 4 simultaneous global expansion sites, and its output timeline aligns with, rather than runs against, compounding AI demand growth. AI demand uncertainty. Valid long-term concern. Reclassified as a structural tailwind. AI demand is globally distributed, self-compounding through output data generation, and subject to the Jevons paradox. Efficiency gains historically expand total consumption rather than reduce it. What genuine risks remain? After working through the analysis, 2 concerns warrant continued attention. First, the near-term customer concentration in hyperscalers is real, even if it is diminishing. A sudden CapEx pause from 1 or 2 major customers could affect revenue in the short term before broader enterprise demand fully offsets it. Second, Chinese competition, while not an immediate HBM threat, is accelerating with significant state backing and should be revisited as CXMT and YMTC progress through successive HBM generations. Export restrictions are the primary mechanism slowing that progression, and their durability is a policy variable rather than a certainty. The broader picture is of a company executing a strategically well-timed transition, moving production out of geopolitical exposure precisely as the threat window opens, holding a generational lead in the memory technology that AI infrastructure cannot function without, and building domestic capacity that qualifies it as both a national security asset and a structural AI utility. The conventional risks that have historically defined the memory industry, commodity oversupply, price crashes, cyclical earnings, have been individually examined in this analysis and found to be either structurally weakened, transitional, or already resolving. The weight of evidence accumulated here, from HBM's physical supply ceiling to the synthetic data loop to the planned naval timeline to the EPS consensus, points consistently toward a company whose valuation discount reflects an outdated mental model rather than current business reality. The path to $1,500 is not guaranteed, but this analysis finds it to be analytically grounded.